Tesla is up again today, and I'm still holding my February calls. I'm actually green on them. And today was a great day for me. I ended the day up $72,000. Our profit and loss for the year is still very, very strong, but I did open a couple of hedged positions. The first is going to be on QQQ, but the one I really want to talk about is going to be Tesla. In this video, I'm going to share with you guys a very simple but effective way to hedge your positions. I feel that when it comes to hedging, nobody explains how to do it properly. Nobody actually gives a formula on how to hedge your positions, and nobody actually teaches about the Greeks. So the first thing I want you to understand is if you want to learn about options in more detail, go take our free course. The link's in the description. You just go to our homepage, you click the Options Trading Simplified course. Everything that we go over in this video is going to have much more of an elaboration as well as techniques that go along with it. That course is completely free, so go and check it out if you want to learn more about dynamic hedging and learn more about what we're going to talk about in this video. Now, the position that I opened was October 18th. You can see it up here at the top left, 2024. So that's this year, $225 puts. Now, my adjusted cost is $78,000. And a lot of the times when people are thinking about hedging out a position, they think about a dollar for dollar valuation. So they'll say to themselves, oh, if I have $10,000 worth of calls, I'll just buy $10,000 worth of puts, and that's a hedge. And that's not the case. The metric that we will be using is delta. About delta and how to hedge your positions in much more detail within the course. Essentially, delta is the rate in which your contracts are going to go up or down. So for instance, if you were to buy one share of Tesla, your delta with that one share is 1. So a common stock is a delta of 1. If we were to buy an options contract and our delta was 78, then that means we are long, if these are calls, 78 shares. I posted within our Discord when I opened this hedge today at 9:59. I said the goal with hedging is to look at the total delta. So for instance, my February 235 calls have a delta of $1,788, which means that if you were to just look at that from a shares perspective, that position is worth 1,788 shares of Tesla. My delta on the October 18th that I opened is minus 2,054. So obviously, I am much more bearish now on Tesla if I have a negative 2,000 delta and only a positive 1,788 delta. This means that if we were to subtract them from each other, the total delta on Tesla in the fund is negative 266, which means I am more bearish on Tesla here than I am bullish. Just from a raw money standpoint, the Octobers were worth $78,000 and the Februarys were worth $114,000. Now, you might think to yourself, and this is why I highly recommend you check out the options course. You might think to yourself, how is the delta so much higher on these October puts when that position is only worth about $78,000 and my calls are worth $100,000? Well, that's because your delta, your Greeks, all of those are going to change depending upon the time of expiration. The expiration date for this is multiple months earlier. This expires on the 18th of October. My other calls expire in February. So if I wanted to have a complete equal hedge and just say, all right, if Tesla, I don't care what Tesla does today, I don't want my fund or my position in Tesla to move at all. What I would do is find a position that would give me a negative 1,788 delta. That is called being delta neutral. So when a market maker takes your order, that's what they're doing. If they bring on 1,000 delta, well, then they have to sell something off in order to become delta neutral. So if I wanted to just be completely neutral today, that's what I would do. I'd buy equal amount of negative delta in put options to the equal amount of positive delta in my call options. If I'm leaning more bearish, then I'm going to buy something that has more negative delta than the actual positive delta. And if I wanted to only put a half hedge on today, so let's just say that I wasn't that bearish on Tesla, but I did think there was maybe a 30% chance it could pull back, what I could have done was went in with about 50%. So instead of 2,000 delta, I could have went with a negative 1,000 delta. And so it's up to you in how you want to keep that ratio as far as exposure. But at the end of the day, that delta is the most important aspect. Now, a better example that's more applicable to most of you would be if you're carrying 1,000 shares long term. If you had 1,000 shares long term of Tesla when it was all the way up here a couple of weeks ago at $268, and you said to yourself, listen, I still think that Tesla is going to continue to run, but if it pulls back, I want to have some sort of downside. And if you don't want to close your shares, and this is a more important thing, if you don't want to close your shares and realize the profit and pay the long-term capital gains versus short-term capital gains, then what you do instead of closing the position is if you have 1,000 shares, you would get puts that have a delta of negative 1,000. And so that's what a lot of these hedge funds do when they are taking positions, right? If you got into Tesla and let's just say, back here, you're up about 60% within 90 days, instead of realizing that profit and paying, 40% taxes, you just open up a put position that negates the trade entirely. You release the put position down here at 190. And then from there, you're back to being a positive delta. You do have to pay the taxes on the option, but at least it's some sort of insurance policy. And now you can just ride Tesla back up to 270 or maybe even 290. So now that we went over delta and how we can hedge our position, let's talk about Tesla and the actual technical analysis heading into the next couple of days. So the main thing that we've been looking at is we do believe that Tesla is probably going to continue to break out to 260 and 280, maybe 300 by the end of the year. The major thing that we were watching here is this $230 institutional level. So if we go through and we remove all of our drawings, right? The first thing that we always talk about is what's the trend? We know that we're making higher lows, so the trend is obviously up. On top of that, we're making lower highs, which means that even though the trend is still up, there's a squeezing or a compression that's happening here. Last week, we looked for the potential breakout above 235. Price pulled back to test $210. The BX trender closed with lower lows, which is why we were expecting a pullback to test $200. But remember, we are always using insurance policies, even against myself. I think that Tesla's going to pull back to 200. That's what I thought at the beginning of this week. But I still held my February call with no hedge in place because I knew that if I was wrong, I would want to not sit here and watch Tesla continue to run while I'm not in a trade. So I kept my calls open. If you want to learn more about all of the indicators that you see in this video, as well as the proprietary settings and the step-by-step trading system that I've built, you can take all of our courses completely free with the link in the description. From here, what we are looking for is to make sure that price can continue to push through this resistance level. So basically, we have to take out this old level. Now, we were bullish on Tesla at the time because we saw this pullback into our support level, bounced, took out a higher high. But the reason that I opened up that put position today for my hedge is because of this 1 hour chart. So in order to hold structure, what has to happen is price has to push through this resistance level. So if we were to take a Fibonacci from swing high here of about $234 down to most recent swing low of $210, if we pull this all the way out, we know that if you're in a downward market structure like we are on the 1 hour, right, you'll notice at this point that in most cases, price will pull into this order block and reject. If it does not reject and it doesn't take this resistance out, then there's nothing stopping this running all the way up to 260, 270, 280. That's why macro, longer time frame, I'm very bullish. However, we put the hedge in place today very specifically because of where we are. In a market structure, bullish, bearish, whatever it is, there's two major zones that we want to watch for. The first is called the golden pocket. This is the 0.786 to the 0.618. This is going to be our institutional level. The reason that this is an institutional level is that if these people were buying down at this support level and they want to take profits into this liquidity because people think the price is going to go higher, the most optimal time for them to get out is going to be within this range because they're selling it not at a discount, but they're selling it at a premium. Like if you were to be buying shares at 210 and then a couple of days later you're buying them at 230, the day that you're buying them at 230, you're not getting a good price. You're actually overpaying a bit. And so in most cases, we will see the market come back down to redistribute into this range of about 220 is really the worst I'm expecting. I think that we could redistribute into this 220 range, worst case back down into 208, 206, but I don't think that's going to happen before maybe finally breaking out into this high. And so my plan is that if we opened up our hedge right here at about 227 today, we're only holding the hedge for worst case about a 2.6% loss. So I'm not going to lose that much on this. But if, right, very low chance, but if Tesla rejected, the market really pulled back, we hit that 2.8, that 210 level, then I would actually make money net net because even though my calls are down, I have much higher delta for this. So the risk versus reward is off the charts, which is why I decided to open the put. Now, if we take out 232 tomorrow, we push through this level and we hold, then I will fully remove my put position on this and I will look to most likely average into my December calls. So I'm sorry, my February calls. I might actually continue to buy more because the last thing that we have to look at here is this liquidity level. So liquidity level occurs where you see price action that's too perfect. You can see price pulls right into this level, rejects, pulls up, rejects, rejects, rejects. So the more time that a liquidity level is hit, the higher of a chance that liquidity is swept. Because you have to remember, you have all these short sellers and who have stop losses set above these liquidity ranges. So if we see big money drive the stock through this resistance, all of these are going to get taken out. When that gets taken out, there's going to be nothing stopping it from moving up to fill this gap that we have here. So short term, there's a chance that we could see price, like I said, pull back, do one of these where we continue to maybe pull back into the support level, most likely bounce at 220, and I do think we'll continue to break out. So worst case tomorrow, I think we see about a 2 to 3% sell-off. I think maybe worst case the market sells off as well, but I do think over the next couple of weeks, as long as we don't see something crazy happen, we should see Tesla break through this 235, 240 area and head for 260 and 280. Thank you guys for watching the video. If you want to trade alongside of me each and every single day, get access to all of my real-time alerts, private live streams, as well as a trading community of over 800 other traders using the same exact strategy that you see here each and every single day. If you want to join the team, you can use the link in the description to join the private mentorship group. If you don't feel like you're quite ready for that, then take advantage of all of the free courses that we have on our website. Thank you guys for all the support, and I'll see you next time.